Joining us now from Red Wave Investments, where he looks over the fantasy team of your portfolio. He is Mark Smith. Mark, we were talking about the Fed earlier on, and Ben Bernanke. I thought this was fascinating when Ben Bernanke says the White House is being too restrictive on their monetary policies. I'm thinking, what? What does Ben Bernanke want to do then if the White House, the king of all the Keynesians, is out there saying, yeah, we don't spend enough? What did you make out of some of the stuff the Fed was saying today?
Well, it was interesting. I think the key points that the markets really rallied on today were, one, the fact that he reiterated the continuation of the bond purchases, the $85 billion a month in bond purchases, and that he said it was going to kind of continue again in kind of in perpetuity. And also, interestingly enough, Bank of Japan did a very similar thing today later on in the afternoon, and that also, I think, helps fuel stocks. But it is interesting, going back to your question on Bernanke, how often he brings up, he's doing what he can on monetary policy, but the government's not really doing its role on fiscal policy, and it always just sounds to me like he's trying to just pass some of the buck on to the government, and we know how dysfunctional the government is now, but
yeah.
But he's kind of like saying, hey, I'm doing what I can do, and not everybody's kind of following along, and so if things slow down, I'm doing my part.
But how long do you think they can keep the interest rates down before they have to start coming up?
Well, that I think is probably the single most important question that we can think about and ask. And I think if you look to Japan, you can see 20 plus years of essentially zero interest rates that they've been living with. So I think sometimes the conventional talk, especially among probably a lot of your listeners and kind of people who think about history and economics and inflation, they would argue that, we can't go on much longer. We can't go on forever in this kind of situation. But I do think Japan serves as a pretty good example of a country that controls currency and has kept this low interest rate environment in place for a number of years. And actually, you could go back to the 40s and 50s in the U.S. and see a similar long, 10, 15-year stretch of what I would call maybe below market interest rates. So, but trying to figure out, how the Fed ultimately starts unwinding this is definitely critical, not necessarily to the next 3 months or the next year, because I think what the Fed is saying is, we're going to continue to push people into riskier assets, so you need to be in the game, you need to be owning stocks. But at some point down the road, they have to start unwinding their balance sheet, and that's going to be the next big thing that people need to follow over the next few years.
Well, and that's really what concerns me. I mean, the interest rates are really how a bank pays its bills, and we watch banks folding or merging, and people, and I can't help but think that some of this is the fact that they can't pay their bills if we keep artificially, squashing their ability to earn the money necessary, the commission, if you will call it that, on the loans they put out in terms of the interest they're going to recoup.
Well, I mean, that's definitely part of it. I mean, you have a situation where loan demand is down. I mean, businesses are not borrowing money like they used to. People are a little more conservative with their borrowing, and banks, so they can't raise interest rates too much to the end user, right, to the consumer, to the businesses, et cetera, and they need to make that money on the interest rate spread. And so, the Fed is kind of saying, hey, we're going to let you keep borrowing money essentially for free from either the Fed or primarily from depositors. And then make that difference. Now, it's interesting to look at how the last few days have carried out in the Treasury market. And at the end of last week, as the markets were rallying, we were hitting multiple highs every single day, and the 10-year Treasury got up over 2%, where it hasn't spent a lot of time in the last 6 months. And then after this whole Cyprus news over the last few days, yields went down to 1.9%, which is a decent move in a couple of days in the Treasury market. And now all of a sudden, since Cyprus seems like maybe they've kind of moved on from that, and then again the Fed reiterated the thing, and we're seeing people shift back into stocks, and treasuries are back up to kind of 1.96 range as people are again moving back into riskier assets.
We mentioned Cyprus and some of the pull that's making. Again, I think you were the one who mentioned yesterday. We're talking about an economy the size of smaller than Vermont, but it does seem to have some pull on that. With the stocks closing up today. The Dow went up 55 points. Not eye-popping or anything, but NASDAQ, S&P. Were there particularly good players, weak ones in what the response to Bernanke's statements today?
Every single sector across the market today was up, and if you kind of look at kind of the 13 main categories that people track in stocks, but definitely the lead was consumer cyclicals, healthcare stocks, which is kind of interesting. I mean, the consumer cyclicals are going to be a lot of kind of higher beta names that tend to do well when the market does well, but healthcare is really shouldn't have any correlation to this Cyprus news, and yet that was one of the leaders today. And actually, financials were kind of right in the middle of the pack, so not lagging or not really standing out. But it did. There was just broad across the board strength today.
Well, it seems like we've kind of gone through some of the volatility, and now we've kind of gotten stabilized a little bit in a more. We kept eye-poppingly climb new heights and new heights. Do you think we've stabilized for a while in the markets, Mark, or are we looking at more volatility in the next couple of weeks?
Well, we've seen volatility kind of be the word of the last, few years, really, and it's hard for me to say that we've stabilized. I mean, I think we saw how a tiny country could spook the markets the other day, but definitely things feel calmer now, and it seems like this Cyprus thing has moved on, although, they're now talking about potentially borrowing money from the government pension assets over there to fund this bailout, which seems like a whole other, disaster to me, but less, I guess, precedent-setting than what they were talking about originally. And so it does seem like that. And when the Fed talks and the Fed makes their statement, they're going to keep buying, they're going to keep injecting liquidity, I think a lot of market participants hear that and go, okay, stocks are still the way to go. They're basically telling you, you need to go buy stocks, you need to go buy risky assets, because we're going to make the alternatives very unappealing, and that's saving, putting in a savings account, buying bonds, et cetera. So I do think there's a lot of market participants that are still going to be bullish on stocks from this point, just again from the Fed reiterating its position.
And that's kind of what you're telling your folks with their fantasy portfolios there. I tease him because I always compare his portfolios to picking a fantasy football team. But
right.
In what you're picking, I mean, is that what you're telling your folks at Red Wave Investments?
Yeah, I mean, it generally is, and I will say, and I've said this before on here, that over the last week or so, I have been, or a couple weeks, I have sold a couple things. I've kind of been a net seller, so I still have a lot invested, but I have raised a little bit of cash just based upon the last, say, 4 or 5 months' performance of the stock market. Like I said, it does feel like things are moved past the Cyprus issue, maybe somewhat stabilized. The Fed's telling you to go buy stocks. So I think that there's always that balance between what the valuation is, what the market's done, and what the what the Fed is telling you to do.
You can find them at redwaveinvestments.com, or you can email him, Mark, M-A-R-C, at redwaveinvestments.com. Thanks for taking a look under the hood of it all, Mark, and we'll talk to you again tomorrow.
Thanks, Joe. Have a good one.
You too. Thanks, Mark Smith, Red Wave Investments, redwaveinvestments.com.